Welcome to FTI Experts Hub. Today, we're taking a step back and a big step forward in thinking about the US office market. Back in April 2020, at the height of the pandemic, my guest, Jahn Brodwin, co-leader of the real estate solutions practice at FTI Consulting, published a thought piece titled The Office Market After COVID. Will it be a zero-sum game? In it, he explored the push and pull shaping the future of office demand, the forces that might bring people back to the office, and those that could drive them away for good. He argued that the outcome could go either way. Some companies would need more space to safely reconnect teams, while others would shrink their footprints permanently after learning to thrive remotely. Almost 6 years later, we're revisiting that article to see what played out as predicted and what didn't. What did he get right about the post-pandemic office? What surprised even the experts? And what does 2026 look like for the sector now? Joining Jahn for this conversation is Ben Steele, also with FTI Consulting, who brings a fresh perspective to the discussion and maybe a few reality checks for those 2020 forecasts. Jahn, let's start with you. Back in 2020, you called the office market a zero-sum game. Almost 6 years later, how close did the market come to that balance you imagined?
Well, thank you for that question. I would prefer to have been more accurate in my prediction than I was, but the answer really isn't all that straightforward. So, I mean, if you look at the statistics that have been put out by various sources, they'll tell you that pre-COVID office occupancy was in the low 90s, and today it's in the 50s. I think that's a little bit deceptive. I think if you narrow it down a little bit more, and if you looked at the statistics of Tuesday to Thursday, every desk is taken and there's people walking around, or there are people set up in conference rooms because there wasn't a desk for them. So, in that regard, I think, I guess if I had to sum it up, I said for Class A properties, it's really comparable today, the occupancies versus where they were pre-COVID. The overall marketplace certainly, I think, is down from where it was pre-COVID. And I think there's really two reasons for that. I think, it's sort of a combination of really the hybrid work environment, which has seemed to take hold in some form, and it continues to evolve. And that also coupled with what we like to refer to in the real estate business as the flight to quality, where people are coming back to the office, but they want a better experience.
And we'll talk about that later as well.
Yeah.
Ben, reading that piece now, what stood out to you as especially prescient, and where do you think John's assumptions might have missed the mark, given how the market actually evolved?
Yeah, sure. So when I reread the piece, I didn't think there was anything that Jan, any predictions or anything Jan said that garnered, us throwing Rotten Tomatoes at him over it, right? I think the main idea really still holds up, right? Like Jan said, we didn't really see like a clean recovery. You didn't see vacancy or anything just bounce back right after COVID. And I think there were some anticipation of that, but I think what Jan really anticipated was that there would be clear winners and losers as it relates to older buildings versus newer Class A buildings. And I think you kind of continue to see that where, newer stock, highly amenitized office spaces in good locations, good CBD locations, not, and good suburban locations in that matter to really kind of continue to outperform. I think one of the areas where the article kind of diverged was, I think we anticipated at the time, that social distancing was going to hang around for a while, right? And I think one of the predictions Jen made there was really like, look, you're going to see the social distancing. This may, really kind of encourage offices and tenants to really widen their footprint, have bigger space, so they can accommodate, properly distanced desks and everything. And you just saw that kind of when those restrictions eased up. You didn't really see that happening. And in some respects, you saw some downsizing to kind of grow and become more efficient, right? Because to Jan's point, you had this situation where occupancies, vacancy, like they would take space, but the physical occupancy by workers would be down a bit, and you're encouraging this hybrid model, and as that evolves, I think you're seeing more efficiency in how tenants are occupying their space.
Yeah,
Mm-hmm.
I think what ended up happening, I think people, I guess what I didn't anticipate is the level of amnesia and how quickly that would set in with regard to spacing, because now we're hoteling space and everyone's packed in even tighter than they
Right.
were
Right.
before. So yeah, I think people just got comfortable with, yeah, these things may happen in the future again, and we know we can work remotely. We know we can bounce back. So, and I think people got comfortable with that pretty quickly. So that's
And
the
did that
amnesia
surprise
effect.
you? Were you surprised by how persistent remote work eventually became?
If I'm being honest, it should have surprised me, but I should have thought about that, particularly since I've been around for a long time, and we know we get over these things pretty quickly. But yeah, I was surprised.
Ben, hybrid models have clearly changed what office demand means. From your perspective, are we seeing a fundamental resizing of the market, or is it still a transitional phase as companies experiment with their footprints?
I think, the way that you're seeing hybrid kind of play out, right, is that as a worker at FTI, I think our culture really survived, during the time where we've really done a lot of remote work, and we're doing a lot of remote work. I think if you had a strong foundation before the pandemic, you maintained it. I think where that kind of differs is that when you have teams growing, kind of onboarding a lot of new folks, really starting a culture, that's where collaboration and being in the office is vital. And I think, what's going on with respect to office leasing in the Bay Area, a lot of the tenants taking up space being AI companies, and they're taking a lot of space. And, I think that has to do with their business model, but I also think it has to do with the fact that a lot of these, AI companies are really in growth mode in terms of their employment and onboarding a lot of teams and really building a culture. And I think you see them grabbing a lot of office space because of that. So I think, the office demand kind of means it's different, right? Collaboration has become more intentional. I think people are really commuting more to, being more of a collaborative environment instead of just
Mhm.
going and sitting down at a desk and doing individual tasks.
Right.
So,
You
They
actually
want there to be a
wrote,
reason to come to the
yeah,
office.
right,
yeah.
right. You actually wrote, Jan, that developing culture remotely would be challenging, if not impossible. Do you still believe that, or have some companies proven that culture can in fact thrive in hybrid or even fully remote environments, apart from FTI consulting?
Of course. Well, I think Ben's I think said it very well. So I mean,
Hmm.
existing culture can survive a storm like we had with COVID, but I believe it's challenging to create a new or pass on to the next generation of culture. I sort of I suppose it also depends on sort of what your definition of culture is, right? All
Right.
companies develop a culture, so it depends on what culture you're looking to create. For those companies that value their own curated brand of culture, I believe remote work makes it very difficult. I don't want to say impossible, but maybe for some, maybe it's impossible, unless it's a type of business that really achieves no qualitative or quantitative benefit from culture, although I'm kind of hard pressed to think of one. And if I did, I probably wouldn't say I wouldn't want to insult somebody.
Of course.
But look, I've always been associated with companies, both employees and my clients, employers and clients, that put a very high value on culture. So I
Hmm.
do believe acculturation is possible with hybrid work environment, as we still get that all important, water cooler time, if you will. But some of this too comes from the fact that and one of the reasons why I wanted Ben to join me on this is like I'm coming to this from a 40 plus year professional career. And I'll embarrass myself a little bit. When I first started at an accounting firm in 1982, we still had people who were 40-year plus professionals I was working side by side with when I'm fresh out of college, and they were doing tax returns with carbon paper. And I look at them like, why do you do that? We have Xerox machines, right? By the way, there were no computers, there were no cell phones, there was no internet. If you needed to do research, we had a library, and you went in there and you took the book out and you flipped through pages. So I grew up in a very different culture, so you couldn't do that remotely, impossible. Now today, obviously, it is possible. But I remember him looking at me, this old timer. Now I'm the old timer. He said, Jan, he said, first of all, he said, there were no Xerox machines when I first started. So I got used to doing literally carbon paper to make 3 copies of the tax return. And I find today people are very sloppy. When you're using carbon paper, you're extremely careful and thoughtful about everything that you do. And I find people who do it my way are much more accurate. They're deathly afraid of making a mistake because if they do, they have to throw it out and start over again. They can't just go to a cell and change a formula, right? Or delete a line and add a new line, right? So some of it comes from that, a cultural divide. And again, I'm glad Ben was able to join because he gives a very different perspective, which is obviously more important going forward than my perspective.
Ben, if we take a step back, what do you think the pandemic permanently changed about how occupiers value office space beyond just cost per square foot? What's the new definition of quality or necessity?
So I really like this question because I come from a hospitality background. I went to hotel school, and then in the kind of 2010, mid 2010s, at FTI we saw kind of an onslaught rise in co-working clients, and I think what all of this means for me is that quality has changed, and it's changed where there's more of an emphasis on like hospitality, right? I think it's more than just having a clean lobby. It's more than just having, being in a recognizable building. You're looking for amenities. You're looking for food and beverage amenities within the building and your space. You're looking for, outdoor space, wellness space, activities that you can do, flexible layouts. None of these are really that new to the industry. I think, it's interesting because co-working really embraced these amenities to differentiate themselves. Good co-working locations from executive offices where they really put a lot of investment into their space to amenitize them. And I think you're seeing that carry on to the traditional office space, right? I think, quality means now having having food and beverage amenities, having all of these things that are have been ingrained in some sectors of the of office space for a while now. You look at tech companies who, the likes of Google and Meta, who have, been well known to have a lot of these amenities in their office spaces, right? And it's been a big attractive selling point for them. And you see, co-working locations like Industrious and WeWork really invest a lot in amenities. And I think that's becoming, a big differentiator between, trophy assets, Class A offices, and older offices who are on older buildings who are unwilling to kind of make that investment into those types of spaces.
Mm-hmm. Let's go back to locations and how important being very close to your office is for when it comes to whether you go or you decide not to go to the office. John, your article actually mentioned a possible shift to the suburbs, echoing what happened after 9/11. Almost 6 years later, we're seeing a mixed picture, right? Some downtowns are still soft, while certain suburban markets are thriving. What explains those differences? How has quality become the new currency in office demand?
Good question. This one, I think I got it at least partially right.
Right.
Which is good for me. The proximity to the office. We used to have our office literally across the street from my apartment. Now it's a few blocks away, and I was very upset that I had to walk 10 minutes instead of 2.
Oh no.
But I live in a city, so but I did commute to the city for many years when I lived in the suburbs. So I do understand and appreciate both aspects. But I think what we saw was an early surge in suburban office demand, as many believed that spoken hub office footprint would work, by replacing some of the costly urban office space with less expensive and expansive, suburban office space. Remember, everyone wanted to be farther apart, and where employees generally live. It kind of made a lot of sense, right?
Right.
So the
Right.
benefit would be lower occupancy costs for the company and less commuting time for the employees. This kind of ended up being a tale of two cities, if you will. The two cities are either winners or losers. Certain cities, I say cities, but I mean suburban centers, achieved really impressive gains in occupancy and effective rent rates. And most of these suburban areas succeeded really because they had high quality amenitized buildings, which we've been talking about, that were available.
Mm-hmm.
You have to have the space available. And near where people live and where people want to live. Because one of the other things we saw was a big shift. People move, right? You hear all the stories all
Mm-hmm.
the time, which are relatively accurate. People leaving New York, moving to Florida, people
Yeah.
leaving LA, moving to Texas, and and then people who always wanted to live in New York moved to New York because the rents went down. But some examples include suburban Virginia
Mm-hmm.
was a real winner. The Fulton Market and River North outside of Chicago did exceptionally well. I had a client of mine who's built a couple buildings. His timing was perfect. Some of the Boston suburbs like Waltham, Needham, Burlington. And what about Nashville? It's killing it. You can't get office space there. Some of the San Francisco suburbs, people didn't want to come into downtown, but Walnut Creek, South Bay have done, very, very well. So similar to what happened in the urban centers, the suburban office market also demands the same highly amenitized office experience as Ben referenced to kind of earn the employee's commute. One thing that's consistent, whether it's CBD or suburbs, it's really that flight to quality, right?
Right.
That I can't emphasize that enough. And the supply was, and still in certain areas, Miami, West Palm, some of the Dallas Fort Worth suburbs they're limited as there was a pause in construction. That was the other factor that we're kind of experiencing now. There was this big demand for certain suburbs, but there was no supply. So if you go down into certain of the outlying areas in Miami, if you're in Dallas Fort Worth, if you're in West Palm, there's cranes everywhere. So
Mm-hmm.
it's going up because I think this concept of suburban spoken hub, I think that's somewhat here to stay. And I
Mm-hmm.
think certain of the suburbs that have really attracted the most attention, are catching up now, on the supply side. And of
Mm-hmm.
course, the states with low or no income tax, like Florida and Texas, have been
Right.
big winners.
Following on that flight to quality concept that you both touched on earlier, investors seem to be increasingly selective. They're backing best in class buildings while others continue to lag. How do you see that capital divide playing out as we head into 2026, Ben?
So it really is, uh, this need for there to be, proactiveness in the space, right? And that's on the part of both companies and companies who use, users of office space and as well as owners of older buildings in particular. And I think, companies that are investing in real estate, I think it's really as users, it's really important for them to see, real estate as part of a broader strategy and not just something that sits off to the side. On the flip side, I think owners, as Jan said, flight to quality, right? Really important. I think as Jan said, owners of older buildings, sitting there and kind of assuming the status quo is going to continue, as it
Mm-hmm.
did previously pre-pandemic, I don't think is realistic. But I think it's a little similar to malls, right? In the sense that malls got kind of stagnant and you saw them kind of not really reposition themselves, re-strategize, and you had this instance where the status quo really didn't pan out for them. Now you don't have some of the issues with malls. You don't have the co-tenancy death spiral in office space like you have with malls. But I think generally speaking, the divide that you're going to see is between newer buildings, right, and older buildings that require significant capital on the owner side, right? And on the user side, I think the divide that you're going to see are companies that invest in, their hybrid models, invest the capital in their hybrid models, and companies that don't. And I think you're going to continue to see kind of how I really think the companies with hybrid models that are focused on investing in quality, highly amenitized real estate space are probably going to outperform companies that don't.
Mhm.
And I think the same is true, on the ownership side. And one of my biggest concerns, right, is that according to some white papers, some of these older properties, only about 15% of them in these CBD markets can really be repositioned. So it's really going to be an adjustment period. Some are going to be redeveloped, some are just functionally obsolete, some are going to be converted. But I think the older inventory that can be successful are the ones that are in good locations and are investing capital into differentiating themselves.
Jahn, back in 2020, you advised lenders not to panic and to focus on understanding tenants' evolving needs. Looking at today's landscape, did that patience pay off? Would you say that? Or who do you think adapted best? And what kinds of owners or operators have managed to stay ahead of the curve?
Okay. So I think for those, I've been asked this question many times, but for those that had the intestinal fortitude and a long-term, low-cost debt, strong tenant roster, they did fine. They were able to navigate the storm without too much of a hiccup. The biggest challenge for many was not just having the vision of what they needed to do and how to respond, but also simply having the patience and the working capital to see it through. Many succeeded, and obviously many did not. So a lot also depends on the structure of their capital stack and the strength of their rent roll. So those that had long-term debt at historically very low interest rates, some still have those debts in place, and had tenants that even if they weren't using their space, obviously were still honoring their leases and were able to continue to pay the rent, even if they weren't using the space. Those properties tended to, live for another day. And as we discussed earlier, those that listened to their tenants and saw where the market was heading and were able to sort of double down on high quality, geographically desirable properties have generally done very well. I mean, I'll give you an example. Even the building I'm here now in New York in FTI's office, the landlord took one space out of circulation and built common area. So there's meeting rooms and dining facilities that people in the building have the ability to access and use. And that's become important because sometimes we have needs for a lot more space and we're able to use that space when we need it. We don't have to pay for it 365 days a year for the next 15 years, right? Pay for it when you need it. The challenge properties were really those that had expiring debt. When your 3% mortgage turns into a 7% mortgage, that's a problem. And where if it's geographically undesirable, if it's in one of those suburbs that people aren't flocking to, or if it's on a side street in Manhattan in a B building, those are problems. Or in many instances, what we've seen, a lot of real estate are owned in private equity funds. And many of those funds have a finite life. They typically have a 10-year life, 3 years to buy, hold for 3 or 4, and then sell for 3 or 4. And if they're at that end of that cycle and they have to sell, that can be a problem. They are selling in the trough rather than the top. But of course, that creates opportunity, right? We'll have to do another.
There's always
podcast
opportunity, no matter where we are in the cycle, right?
It's kind of interesting. It's like when somebody's winning, someone's losing, right?
Right.
That's the way it works.
Right. Ben, if we look toward 2026, it feels like success in the office sector will depend less on timing the market and more on having the right strategy for the right asset. What do you think will separate the winners from the rest? Will it be capital discipline, creativity, or something else entirely different?
I think it could be it would be capital discipline. Not every building can be easily repositioned.
Right.
Some there's not really going to be an economic path forward. Some of these side street Class B buildings, like Jahn mentions that they may not have a viable path forward as an office space, and I think that's coming to fruition right now. a lot of the maturity issues, private equity issues that Jan talked about, I think we saw a lot of that happen in downtown LA. I
Hmm.
think you have almost bankruptcy row in areas of downtown LA, or not even bankruptcy row. You have, the Brookfields of the world throwing the keys back to the lender. I think a lot of those are timing related. I don't know that we're going to continue to see kind of those timing related issues. So I really think it's capital discipline at this point, with respect to being an owner and really modernizing and repositioning your properties.
John, if you were to rewrite your article today, what would its thesis be? Do you still see the office market as a balance of opposing trends, or has it evolved into something else, maybe more structural?
I mean, it's a good question. So if I'd have to think about it a little bit more. But one of the things that I still believe is that being in the office on a full or a close to full time basis, as more and more employers, by the way, are asking from their employees, this will continue. I think this will continue to trend up, which will create a little bit more market demand. I don't think it'll go back to where it was. So some form of hybrid is definitely here to stay.
Hmm.
So my thesis is, okay, this is what it's going to be. Now what do we do, right? I can't change that. I can only react to it and respond to it. But reported occupancy numbers still will still need to distinguish, and they should, but they don't, between occupancy on Tuesday through Thursday rather than
Hmm.
weekly occupancy, as these stats are flawed, as I explained earlier.
Hmm.
They show you averages, but the averages don't mean anything. What we need is the high watermark, and the high watermark is Tuesday, Wednesday, Thursday. So how do we
Right.
get to spread that out? Different companies try different things. If I want to have a meeting in the office and I got to get everybody in, I declare I have a meeting on Monday, or we order in lunch for the office on Fridays. I mean, companies will experiment with different things to try to rebalance that so that they can bring down their sort of high watermark occupancy need. So
Hmm.
that's, to me, is going to be the most interesting challenge, and I don't know where that's going to end up. Hoteling office space helps partially solve for that, but the longer term negative impact, in my opinion, that it really has on getting people back to the office, to facilitate building and reinforcing the company's culture. We need to get people back to the office if we're going to instill the culture. And one of the interesting things I see is that the people who have the culture, the people who've been at the company for, in some cases, decades, they don't need to come to the office for culture. They lived the culture. Many of them helped create the culture, right?
Right.
It's the young people that we want to acculturate into our firm and our way of doing things. But if we don't have the people who least need it to get into the office to teach it, that's the challenge. I know
Hmm.
I face it. I think most companies, face it. I think that's the part that I need to figure out, and a lot of companies are struggling with. Some have been very bold, right? I don't have to name names. You can read about them in the press. That are basically, if you don't come back to the office, you're fired. I've heard all sorts of
Yeah.
things along those lines. But to me, that water cooler time is just invaluable, and you need to have from the youngest to the oldest around that water cooler in order for it to work. So I think that landlords and tenants who understand this and continue to earn the employees' commute, those are the ones that are going to lead the pack. Exactly how they're going to do it, I mean, we
We'll
keep
see.
learning more and more. We keep trying new things. Some work, some don't. Some work for a little while and then fade. If you order in lunch every day, after a while, it becomes a perk. It's not a special thing, right? So we
Right.
just keep experimenting.
Finally, Ben, as someone bringing a fresh perspective to this conversation, what's your long-term outlook when you look at office design, usage, and investment heading into next year and beyond? What gives you optimism, and are there any things that still gives you pause?
I think I'm optimistic that the properties that are doing well, the office spaces that are doing well, modern buildings and good locations, either big suburban nodes with good schools, good amenities, retail, good,
The whole
kind of
package.
house, the whole package. I think they're going to continue to do well. And I think, the CBDs that have performed well, the modern buildings, those are going to either continue to recover and improve, or those buildings are going to continue to lease and release. I don't think, the office is disappearing, right? Like people have pronounced over the years certain property sectors as dead, certain markets as dead, and I don't think that's the case with the office. I think it's just being redefined. What gives me pause, as I've said before, it's really kind of the dinosaurs or the properties in challenged locations that really their path forward isn't as clear.
Mm-hmm.
And I think, the status quo is not kind of going to be helpful. And it's going to be interesting to see how kind of that plays out relative to your redevelopment, repositioning, what that means for kind of the greater built environment in these locations, and what it means for, other kind of secondary, issues, financing, lenders, distress. I think that is not a clear picture, and I think there's something that gives me pause about that.
Mm-hmm. And now one last question for both of you. If you could each summarize the office market's trajectory since 2020 in one word, what would it be and why? I know this one can be tricky and difficult at the same
Yeah.
time.
You want to go first, Ben?
Sure, I'll take it. I think fragmented, like I was just saying, markets and properties have their own specific challenges. I don't think you can, paint it with one broad stroke. I think you have a fragmented office sector, and there are some clear winners and losers, and kind of seeing how that continues to play out, and see how wide kind of the market is, and if it continues to be that way is something that's interesting to me. I'm optimistic about tenants willing to pay for high quality space in well located areas, and I think it's really kind of the fragmentation of the older stock and inventory that tends to be the real question mark in my mind.
So thank you, Ben. You used the word just a moment ago. I'm gonna use that one word because it really does sum up my thinking. It's evolving.
I was trying to set you up there, Jan.
Thank you. I appreciate that. But as an example, and again, Ben touched on it earlier. I remember when malls were in their death knell, and people were
Right.
feeling that there was no hope. Today, many malls have been reimagined into community centers, last mile distribution hubs, mixed use, hospitality, residential properties, medical centers. Some of them were just torn down and made into parks. So they figured it out. I'm suggesting that the same will be true for office. We're going to figure it all out. Some properties are being torn down and rebuilt. I mean, a great example, JP Morgan Chase's new headquarters. There was a 40-story office building. It's literally a block away from where I live. I watched for years tearing it down and building it up. So that can be done, and it will be done. Others are being fully or partially converted to residential. I'm working with a number of clients right now with office buildings, and we're running feasibility studies on converting them into residential or mixed use.
That's a big trend.
And I think it's really, I'll stick my neck out on this one a little bit. It's a very interesting opportunity for end users who may not need to be in a Class A neighborhood on a main avenue to acquire their own properties at bargain basement prices. I've seen it. I've worked on a couple of projects where tenants were looking to move into a space and ended up buying the building or making an investment in the building. And by the way, this is not unusual. Many, many, many years ago, this was quite popular. Well, first off, JP Morgan Chase just did it. But if you look, the Chrysler building, Chrysler built it and owned it. The Pan Am building, it's now called MetLife. The GE building, the GM building, the Sears Tower, I think they call it the Willis Tower now. Huge buildings, all built by companies for their own use. Ultimately, most of them sold them for different reasons. But again, this is something that I think we could see more of. And particularly, it's an opportunity to buy space really, really cheap. Again, for those who have the balance sheet to support it, and don't need to, be on a main avenue or in a particular high demand space.
Ben, Jahn, thank you so much for your time. It's been great talking to you both.
Thank you so much.
Thank you so much, Laura.
Thank you all for listening. If you enjoyed this conversation and want to hear more commercial real estate insights, make sure to follow CPE Podcasts on Spotify, Apple Podcasts, or wherever you like to listen. That's where you'll find all of CPE's podcast series, including FTI Experts Hub, so you'll never miss an episode. And of course, you can always stay up to date with the latest news, trend stories, and industry insights on our website. Until next time, I'm Laura Valean. Thanks for tuning in.